I asked 3 advanced AI models to design the ultimate stock market portfolio for 2025, and the results were surprisingly consistent. Instead of generic advice, they pinpointed a massive sector rotation that could see specific stocks rise by double digits next year. Most investors are still looking at last year's winners, but the AI suggests that the easy money in those names has already been made. I engineered a specific prompt that forced the algorithms to prioritize strong cash flows and protection against inflation volatility. The AI returned a barbell strategy consisting of 5 specific high conviction plays and 1 dangerous sector you must avoid. This isn't financial advice, but a breakdown of what the smartest data models on Earth think will happen to your money. The first pick the AI identified is what it calls the infrastructure sovereign, and it doubles down on the hardware theme. It pointed directly to NVIDIA, arguing that we are shifting from the training phase of AI into the inference phase. Inference is when consumers actually use the models daily, requiring massive continuous computing power from data centers globally. While competitors are trying to catch up, the AI noted that NVIDIA's software moat makes it incredibly sticky for developers. However, the risk is customer concentration. If big tech giants cut spending even slightly, this stock could face a sharp correction. The AI suggests dollar cost averaging here rather than buying a lump sum, as the valuation remains historically high. Moving to the second pick, the AI pivoted to software, selecting Palantir as the operating system of the future. The logic is that companies have bought all these expensive chips, and now they need a platform to actually make them useful. The AI highlighted Palantir's boot camp sales model, which has drastically accelerated their commercial customer acquisition rate. It views this as a high volatility play, meaning you should expect wild price swings around their quarterly earnings reports. The key metric to watch here is a rule of 40, ensuring their combined growth and profit margins remain elite. For the third recommendation, the AI made a surprising turn into the boring utility sector, focusing on nuclear energy. Data centers are absolute energy hogs, and the current U.S. power grid cannot handle the gigawatts of demand coming online. The AI suggested looking at companies like NextEra Energy or Dominion that are positioned to power the AI revolution. Nuclear is the only carbon-free energy source reliable enough to run servers 24/7, making it a critical asset class for 2025. This is a pick-and-shovel play, investing in the electricity that powers the tech, which is often safer than the tech itself. The risk here is regulatory red tape, as building new transmission lines takes years of government approval and heavy capital. Fourth on the list is the demographic destiny play, where the AI selected Eli Lilly in the healthcare sector. Regardless of the economy, the population is aging and the demand for GLP-1 weight loss drugs is skyrocketing globally. The AI predicts these drugs will be approved for additional conditions like sleep apnea, creating a multi-year revenue tailwind. It labeled this stock as a growth defensive hybrid because people do not stop taking their medicine during a recession. However, political risk is high, as government pressure on drug prices could cause temporary panic selling in this sector. Finally, to protect your capital, the AI chose Realty Income as the income shield for the portfolio. Real estate investment trusts have been crushed by high interest rates, making their valuations look very attractive right now. The AI believes that as interest rates stabilize in 2025, high-quality real estate will see a significant price recovery. Realty Income pays a monthly dividend and focuses on essential tenants like grocery stores that don't go bankrupt easily. This position acts as an anchor, providing you with steady cash flow to reinvest even if the stock market stays flat. I also asked the AI what to strictly avoid, and it immediately flagged legacy media and cable TV as a value trap. It analyzed ad revenue trends and concluded that money is leaving traditional TV for digital platforms faster than expected. Even if these stocks look cheap on paper, the AI warned that their underlying business model is in a structural decline. So, how do we combine these 5 picks into a portfolio that can actually survive the volatility of 2025? The AI proposed a core and satellite allocation, putting 50% of funds into a low-cost S&P 500 index ETF. This ensures you never underperform the broader market, as half your money is just riding the general economic wave. Then, allocate 30% to the high-growth picks, NVIDIA, Palantir, and the nuclear utility plays, to generate extra returns. The final 20% goes into the defensive buckets, healthcare and the dividend REIT, to reduce overall portfolio volatility. The AI specifically warned against diversification, which happens when you buy too many mediocre stocks you don't understand. It also noted that 2025 will be a year of narrative shifts, so automating your investments is the best psychological hack. Setting up automatic weekly deposits removes the emotion from investing and prevents you from panic selling during dips. The AI's worst-case scenario for this portfolio is stagflation, where high inflation meets a slowing economy. However, the energy and healthcare picks are specifically chosen to act as buffers in that exact economic environment. I am personally going to track this exact strategy with real money to see if the machine can beat the human fund managers. If you want to see exactly how I set this up and track the performance, make sure you are subscribed to the channel. Leave a comment with your highest conviction stock for 2025, and let's see if the community can outsmart the AI. Thanks for watching, and remember that the best investment you can make is always in your own financial education.